The VIX, it actually got to 15.4. It settled below the 15 handle, but it's starting to creep up. And as Joe mentioned, it had been actually climbing this year, surprisingly.
Yeah, I think that was maybe a little bit of a warning sign that people were starting to realize last week that it was getting a little bit silly. I mean, we talked last week on this program about the market feeling like it was a bit of a sugar rush, a sugar high. And the fact that people were buying options even in the second half of last week maybe suggests that there was a desire to maybe slap on some hedges. And, I guess now we can say it was probably the right thing because, you eat too much candy, you go to the dentist and you get drilled.
So you were looking at what the VIX suggests in terms of a drawdown in the S&P 500. We've pulled up a chart here, G#BTV834. Walk us through what you see here.
Yeah, no, as we know, there is a very good long-term relationship between the VIX and trends in the stock market. Stocks go up, the VIX tends to go down. Over the short run, you can sort of quantify that relationship by saying, okay, X percent in the S&P would equate to such a move or such a level in the VIX. So this is using data since the beginning of 2016 and just seeing where the VIX is. I'm trying to explain, what's the drawdown from the high. The all-time high in the equity market. And the data suggests that VIX below about 10.7 is consistent with stocks at all-time highs, and anything above there suggests that stocks either are or should be, or the market is pricing a drawdown. So VIX where we are, 14 and a bit, that's consistent with a drawdown from the high of about 3%. For the S&P, which is a little bit further than we've got to go.
You can also take your pick on risk events this week as well, whether it's the Fed, whether it's earnings, the big tech names, State of the Union, you name it. To what extent are we seeing a correlation connection between what we're seeing in the rates market versus equities?
Well,
what's leading here?
I mean, funny enough, to my mind, one of the biggest risk events that we've got this week is something you haven't mentioned, which is something that it's very in the weeds stuff typically, which is the Treasury's quarterly refunding announcement, where they announce their anticipated auction schedule of Treasury securities for the next quarter. It is big because what we're going to see is projections for issuance not only in the coming quarter, but in the coming years. And we haven't really seen an uptick in Treasury issuance, net Treasury issuance, since the financial crisis. And courtesy of the fiscal easing from the tax cut, we should see a pretty large increase in Treasury issuance coming at a time when the Fed is going to be pulling back, coming at a time when corporations are potentially going to be bringing money back home. Corporations are large owners of bonds. You could kind of be seeing if you will, a perfect storm of supply.